In September 2019, the overnight lending rate in the United States repo market suddenly spiked from 2% to 10% in a single trading day. The Federal Reserve was forced to inject $75 billion in emergency liquidity into the financial system, the first crisis intervention of its kind since the 2008 collapse. This event barely made headlines, yet it exposed a vulnerability in a parallel financial system that now controls over $250 trillion in global assets. While traditional banks have been subjected to stricter regulations since 2008, a vast network of hedge funds, money market funds, and private credit firms operates in the shadows with minimal oversight. This is the shadow banking system. It is larger, more leveraged, and more interconnected than ever before. And according to the Financial Stability Board, it is growing at double the rate of traditional banking. The question is not whether this system will collapse. The question is whether we will recognize the warning signs before it is too late. Shadow banking is not a new phenomenon, but its scale has transformed it from a niche concern into a systemic threat. The Financial Stability Board defines it as non-bank financial intermediation that operates outside traditional regulatory frameworks, yet performs bank-like functions. These institutions include money market funds that promise instant liquidity, hedge funds that amplify returns through leverage, private equity firms that control entire industries, and specialized lenders that originated over $1.1 trillion in loans by 2023. They borrow short-term money to invest in long-term assets, the exact maturity mismatch that has triggered every banking crisis in modern history. What makes shadow banking particularly dangerous is its interconnectedness with the traditional financial system. According to research from the Federal Reserve, U.S. banks have lent nearly $300 billion to private credit providers and another $285 billion to private equity funds as of June 2024. When stress emerges in shadow banking, it does not stay contained. It spreads through the repo market, the commercial paper market, and the collateral chains that tie the entire system together like a web of tripwires. The first major warning came in August 1998 with the near collapse of long-term capital management. LDCM was a hedge fund founded by legendary bond trader John Meriwether and staffed with Nobel Prize-winning economists who believed they had conquered financial risk through sophisticated mathematical models. The fund operated with leverage ratios exceeding 25 to 1, meaning that for every dollar of actual capital, it controlled $25 in positions. When Russia defaulted on its debt in August 1998, global markets experienced what LTCM's models considered statistically impossible, a flight to liquidity that turned their arbitrage strategies into catastrophic losses. Within weeks, LTCM lost $4.6 billion and faced imminent liquidation. The Federal Reserve Bank of New York orchestrated an emergency bailout on September 23, 1998, bringing together 14 banks and brokerage firms to inject $3.6 billion in fresh capital. The rescue succeeded not because LTCM was too big to fail, but because its positions were too interconnected to unwind safely. Every major financial institution on Wall Street had exposure to LTCM through derivatives, repo agreements, and prime brokerage relationships. 9 years later, history repeated itself on a vastly larger scale. In June 2007, two Bear Stearns hedge funds collapsed under the weight of mortgage-backed securities that suddenly became illiquid. Bear Stearns attempted a $1.6 billion bailout of its high-grade structured credit fund, but the damage had already spread. The asset-backed commercial paper market, which had grown to $1.18 trillion, began to contract violently as investors refused to roll over short-term funding. By August 2007, the ABCP market lost $350 billion in value over 5 months, transforming concerns about subprime mortgages into a global liquidity crisis. The shadow banking system, which had grown to rival traditional banking in size, discovered that its entire funding model depended on continuous confidence. On September 16, 2008, the Reserve Primary Fund broke the buck, meaning its net asset value fell below $1 per share because of its exposure to Lehman Brothers commercial paper. This was only the second time in history a money market fund had suffered such a fate, and it triggered a run that pulled $310 billion out of prime money market funds in a single week. The commercial paper market froze. The repo market seized up. Investment banks that had operated for decades suddenly could not fund their operations overnight. The pattern is consistent across these crises. Shadow banking institutions employ high leverage to magnify returns during calm periods, creating the illusion of sophisticated risk management. When unexpected shocks occur, liquidity evaporates faster than models predict because shadow banks lack the deposit insurance, central bank access, and capital buffers that protect traditional banks. The institutions most confident in their risk models are often the most vulnerable when those models fail. The 2008 crisis prompted global regulators to impose stricter capital requirements on traditional banks through Basel III standards, but the regulatory response created an unintended consequence by pushing more financial activity into the shadows. Banks reduced their balance sheets and lending activities to meet new requirements. Shadow banking entities expanded to fill the gap, operating with leverage and maturity mismatches that would be prohibited in the regulated banking sector. Today, the shadow banking system has reached unprecedented scale. According to the Financial Stability Board's December 2024 monitoring report, non-bank financial intermediaries now control $256.8 trillion in global assets, representing 51% of the entire financial system. In the United States alone, narrow measures show shadow banks held more than $19 trillion in total assets as of 2022. This figure excludes insurance companies and pension funds, focusing only on entities that pose direct financial stability risks through their leverage and liquidity profiles. The sector is growing at 9.4% annually, compared to just 4.7% growth in traditional banking. Money market funds reached $7.1 trillion in net assets by November 2024, while the private credit industry expanded tenfold to $1.1 trillion by 2023. This growth has occurred with minimal regulatory oversight. Shadow banks are not subject to the stress tests, capital requirements, or resolution frameworks that govern traditional banks. The September 2019 repo market crisis offered a preview of the system's fragility. On September 16th, corporate tax payments drained reserves from the banking system. At the same time, Treasury settlements created unusual demand for overnight funding. The result was a liquidity squeeze that sent overnight repo rates soaring to 10% intraday, 5 times the Federal Reserve's target rate. The spike revealed that the repo market, which handles trillions of dollars in daily transactions, operates with razor-thin liquidity buffers. The Federal Reserve responded immediately, conducting overnight repurchase operations of up to $75 billion per day and continuing these interventions for months. This was not a one-time emergency, but evidence of structural fragility in the plumbing of the financial system. What made the crisis particularly concerning was its cause. No major institution had failed, no market had collapsed, yet routine payment flows nearly froze the overnight lending system that shadow banks depend on for daily operations. Research from the Federal Reserve Bank of New York shows that shadow banking institutions have become increasingly systemic over time. Their risk profiles exhibit common variation, meaning that stress in one sector tends to correlate with stress in others, amplifying the potential for contagion. The connections run through multiple channels. Traditional banks provide credit lines to hedge funds, warehousing facilities to private credit firms, and custody services to money market funds. When shadow banking entities face funding stress, they pull on these credit lines simultaneously, concentrating pressure on banks that regulators assumed were safely capitalized. The 2025 Federal Reserve exploratory analysis specifically examined risks that non-bank financial institutions pose to banks through these interconnections. Private credit firms present a particularly opaque risk. They originate loans to companies that cannot access traditional bond markets, often using leverage and complex structures that obscure true credit quality. These loans sit on the balance sheets of entities with minimal disclosure requirements. When economic conditions deteriorate, both the private credit firms and the banks that finance them will face losses that current capital models may not adequately anticipate. The mathematics of leverage works beautifully during periods of growth and stability. A 20% return on equity becomes 100% when amplified by 5-to-1 leverage, creating enormous wealth and impressive track records. But leverage works symmetrically on the downside. A 5% loss on assets becomes a 25% loss on equity with 5-to-1 leverage, and a 20% loss wipes out the entire capital base. Shadow banks operate with leverage ratios that often exceed those of traditional banks before 2008. Hedge funds routinely employed 10-to-1 leverage or higher, while certain credit strategies push ratios even further through derivatives and off-balance sheet exposures. The Financial Stability Board's 2025 report on leverage and non-bank financial intermediation warned that interconnectedness, concentration, and crowded trades amplify the financial stability risks created by this leverage. When multiple institutions hold similar positions, financed with borrowed money, small market moves can trigger cascading liquidations. Policymakers recognize the threat but face formidable challenges in addressing it. Shadow banking exists precisely because it operates outside traditional regulatory frameworks, and extending those frameworks faces political and practical obstacles. The Dodd-Frank Act gave the Financial Stability Oversight Council authority to designate systemically important non-bank financial institutions for heightened oversight. But this process has proven slow and contentious, with firms challenging their designations in court and regulators reluctant to expand their mandates aggressively. International coordination through the Financial Stability Board has produced monitoring frameworks and policy recommendations. Yet monitoring is not the same as regulation, and recommendations lack enforcement mechanisms when national regulators choose not to implement them. The result is a financial system where the regulated sector shrinks and deleverages, while the unregulated sector grows and takes on precisely the risks that regulations were designed to prevent. This is not a stable equilibrium. The trigger for the next crisis could come from multiple directions. A rapid increase in interest rates could expose duration mismatches in bond portfolios, forcing leveraged funds to liquidate positions simultaneously. A geopolitical shock could freeze cross-border funding flows, leaving international shadow banks unable to roll over dollar-denominated debt. A default by a major private credit borrower could reveal that credit quality was worse than investors assumed, triggering redemptions across the sector. What matters more than the specific trigger is the structure of the system. Shadow banks have grown accustomed to cheap, readily available funding in liquid markets for even complex securities. When that funding becomes scarce or those markets seize up, the system lacks the shock absorbers that protect traditional banks. There is no deposit insurance to prevent runs, no access to Federal Reserve discount windows, and no orderly resolution frameworks to manage failures. The pattern resembles the years before 2008, when credit default swaps and structured investment vehicles operated in regulatory shadows. Sophisticated market participants convinced themselves that financial engineering had dispersed risks so effectively that systemic crises were relics of a less enlightened age. The 2008 crisis proved that dispersing risk through complex instruments actually concentrated it in unexpected places and made the system more fragile rather than more resilient. Today's shadow banking system has grown even larger, with even less transparency, while regulators and market participants express the same confidence that sophisticated risk management prevents systemic problems. Ben Bernanke testified to Congress in March 2007 that subprime mortgage problems would be contained. 6 months later, the shadow banking system began its collapse. Today, central bankers acknowledge that non-bank financial intermediation poses systemic risks, but their proposed solutions focus on better monitoring and marginal reforms rather than the fundamental redesign that system fragility demands. The conventional wisdom holds that financial markets have learned from past crises, and that modern risk management, diversification, and regulatory oversight have made the system safer. The growth of shadow banking is presented as evidence of financial innovation, efficiency, and the healthy evolution of capital markets beyond traditional banking. The contrarian insight is that this growth represents the exact opposite. Shadow banking has grown precisely because it avoids the regulations and capital requirements that make traditional banking safer. Its size, leverage, and interconnectedness mean that the next financial crisis will be larger and more complex than 2008, because the institutions at the center will be less transparent, less regulated, and less prepared. The Federal Reserve's interventions in 2019 demonstrated that it stands ready to support shadow banking when crises emerge, but this implicit backstop only encourages more risk-taking. The $250 trillion shadow banking system is not an alternative to traditional banking that operates on different principles. It is a recreation of the exact vulnerabilities that caused previous crises, now operating at a scale that dwarfs the 2008 system. The collapse that nobody is prepared for is not the one that will surprise us with its cause. It is the one that will surprise us with its magnitude, despite all the warning signs that were visible years in advance. Financial history teaches that leverage, maturity transformation, and opacity create fragility. Every generation learns this lesson through crisis, rebuilds with regulations and reforms, then watches as new institutions emerge to replicate the same patterns in new forms. We are watching that cycle repeat in real time. The shadow banking system is not evidence that we have moved beyond the old rules of financial gravity. It is evidence that we have forgotten them.